As we are approaching the end of the year, we would like today to outline our macroeconomic scenario for 2014. In 2014, we expect the global economy to grow at a higher pace than in 2013. Crucially, we expect and forecast the US economy to expand by 2.6% versus 1.6% in 2013. The fiscal tightening via higher payroll tax and automatic spending cuts was a significant headwind for growth in 2013. We expect its negative impact to ease during the course of 2014, allowing the US economy to show its true potential. The diminishing impact of austerity programs in the Eurozone should allow a modest recovery toward 1% or so in 2014 versus 2013, where there was a slight recession of minus 0.3%. The UK and Japan should grow by 2% or so. Emerging markets, which have been disappointing for the last 12 months, should stabilize and benefiting from growth in export toward advanced economies. In such a context, central banks will maintain their extremely accommodative monetary policies as there is no sight of inflationary pressure. As a consequence, equities should continue to do well, at least relative to government bonds, even though valuation levels are not compelling anymore. The US Federal Reserve is likely to be the first central bank to tighten policy, scaling back its bond purchases in the first half of next year, and possibly raising interest rates 1 year thereafter, in the first half of 2015. This should lead to dollar strength over time. What could derail such a positive scenario? Well, a repeat of the US government shutdown would maintain uncertainty about long-term fiscal policy. Without confidence in policy, companies which are cash-rich will not boost investment. Without a boost in investment, the US economy would continue to struggle and grow by a tepid 1.5 to 2%. We believe it is unlikely to happen again because US citizens have expressed their dismay at their leaders unable to strike a compromise. Another source of stress could be again the Eurozone. It has become less likely because current account imbalances have been resolved. But the failure for the economy to grow would feed popular discontent. In such a context, fixed income markets would do reasonably well and equity would be constrained by the lack of earnings growth. Over the month of October, we have trimmed somewhat our equity exposure, taking profits after a strong rise. Overall, we remain overweight risky assets as we run substantial exposure toward high-yield corporate bonds and emerging debt. That being said, we observe higher valuation levels, and we should be cognizant that under the current environment, zero interest rates, we might see excessive valuation and possibly asset price bubbles.